Hello, and thank you for attending this short training on risk versus reward long-term trade-offs. Today we will look at risk versus reward through the lens of financial planning decision making. A few things to think about as we journey through this presentation. How do we classify risk from a traditional sense? And how should we classify risk from financial planning? Can we live with risk? If not, how do we reduce our risk? How can we classify reward? Are some rewards worth taking a risk? As you can see in this chart, it's an example of the efficient frontier and the power of diversification. On the x-axis, it measures risk, measured by standard deviation of annual returns. And on the y-axis, it measures the return, an average of annual return. So as you can see, a 100% bond portfolio theoretically is less risky with less average return compared to a 100% stock portfolio, which is inevitably more risky but a higher rate of return. Typical thought is to produce more rate of return, you have to take more risk. Well, today we're not viewing risk versus reward through portfolio management per se, but from the lens of financial planning. So let's dig in. What risk is the skydiver taking? So he has no parachute. So the question we would ask ourselves, is he taking any risk or is there no risk taking? I would argue that because we know his outcome, that he'll hit the ground and not survive, that there's no risk. So the expected return in this case would be not to survive the fall. So because we know what our outcome will be, there's no risk taking. So risk from the definition standpoint is the possibility that an outcome will not be as expected. So if he jumps out of an airplane without a parachute, the expected outcome is death. So therefore, from the risk perspective, there's no risk taken. So let's broadly look at risk and what we might classify throughout this category. So there's investment risk. This encompasses the many items that we would typically think about: efficient frontier, modern portfolio theory, alpha, beta, standard deviation, things of that matter. Inflation risk. Will the things that I can purchase today for $1 be priced the same in the future? What if cost of goods are more expensive in the future? How do I deal with that risk? Personal non-investment risk. So when we think about this type of risk, we could put it into two categories: risk control and risk financing. Risk control would be avoiding the risk or reducing risk exposure, and risk financing would be choosing to retain the risk or transferring the risk via insurance. For an example, for risk financing is a healthcare deductible. You're choosing to retain a portion of the risk, but then transferring the rest via insurance. Business risk. Is a company going bankrupt? How will they survive through various economic cycles? As the saying goes, don't put all your eggs in one basket. Market risk, referred to as systematic risk. This is the possibility of an investor experiencing losses due to factors that affect the overall performance of financial markets, which, as the saying goes, all ships rise together and fall together. Longevity risk. Will I live longer than expected? What if my financial plan is looking to age 90, but I live to age 100? How should we think about that risk? Sequence risk. This is outlining the order of market returns. What if I have 3 good years followed by 2 bad years? Is that different than having 2 bad years followed by 3 good years? It's particularly important if you're taking income out of your portfolio to consider sequence risk. Tax risk. This is the risk we take of tax rates changing in the future. If rates go up and we're not planning for it, we may end up paying more tax than what's expected. This is a big picture look at the investment risk spectrum. As we've already outlined, there's business and financial risks that we may take. So this is sort of the bullseye, the central theme that all market participants operate in. Unsystematic risk is diversifiable risk. This would be an example of two businesses in separate sectors, like biotech or Clorox. They operate in two different industries, and so therefore their risk can be diversified at the portfolio level. Systematic risk is non-diversifiable. That's when we're thinking about the market as a whole. As, for example, 2008, 2009, the Great Recession, or even the pandemic of 2020, the market in general all fell together, stocks and bonds, although at different rates. As we look in the blue section, though, we're now classifying in 4 separate quadrants different types of investments that we may take on. Cash investments. If I put 100% of my portfolio in a cash investment, is there any risk? Well, I would argue that there's purchasing power risk, aka inflation. So we have to think about today, going forward, what's our chance of things costing more in the future? And if we expect inflation to increase, cash would not be the best choice long term. When we go to the lower right quadrant, bonds and fixed income, there's interest rate and credit risk. Interest rate risk is if, for example, rates being near zero, if the Federal Reserve chooses to raise interest rates, now the bond that I own is worth less than a bond that I could purchase at a higher interest rate. So therefore, that impacts the value of my current holding. So it means that my bond price would go down. Credit risk would be the underlying risk that the company that I'm lending money to by borrowing, they're borrowing from me via the bond, that they go bankrupt or they default on their payment. A good example of this was when GM went into bankruptcy many years ago. Bondholders did not get paid back. Neither did equity owners. So there's an example of credit risk. Stocks and equities. Obviously, we're all aware of market risk and volatility that we see each day as if we're stock investors. The market goes up and the market goes down. Different stocks have different levels of volatility, and that's something to think about as we're investing accounts. U.S. and global investments. There's geopolitical risk and economic and currency risk. So since we're now a more interconnected global society and global economy, we have to be aware of what other central bankers are doing and what the dollar may be doing compared to other currencies. One interesting thing about this chart is thinking about asset allocation. Would we be 100% cash, 100% bonds and fixed income, 100% stocks and equities, or 100% global investments? And you would argue that maybe in none of these cases you'd be 100% one versus the other. So we always have to consider risk in various sectors and diversify and create a well-allocated portfolio. Reward or goal? I thought long and hard about reward or goal and how best to explain goal setting for clients. And I thought about if I had $1 million all of a sudden dropped in my bank account, what would I do with the money? And I concluded that there's only 3 options. You would either give it all away, you'd use it to live, or you would save and invest it. And how I choose to use my resources ultimately creates my legacy. So for instance, if I choose to give 100% of my money away, would that be wise? Arguably it would not be, because I wouldn't have anything to live and I wouldn't be planning for the future. If I choose to spend all of my money and not invest it for the future or consider some of the needs of those around me, would that be wise? Likely not, because we have to think ahead and plan and be good stewards of what we've been given. But if I saved everything and invested everything, but did not consider what I need to live on today, or maybe what others around me may need, say loved ones that I choose to gift to, is that wise? I'd say no, we need to enjoy the life we have and be wise with our spending. So it's a combination of giving, living, saving, and investing. So from this perspective, I want to demonstrate how we use our financial planning program to make decisions based around how we would give, how we would live, and how we should save and invest. So one moment as I change my screens. This screen here is a sample client, and it's a typical view of financial assets that are being dispersed over time. In this client's situation, they're 62 and 61 years old. They're working for a couple more years growing their assets, but then they retire and they are now drawing income from their portfolio. As you can see, with their life expectancy at age 95, the level of assets that they're drawing down and the growth rate that they're generating does not provide for their income needs over time. So if this client were to come to me and say it's a priority to give assets away to, say, a child or a loved one at $15,000 a year, we could analyze the situation to see the impact that it may have on their portfolio. And as you can see in this case, giving away $15,000 a year to a loved one does have an impact. It reduces funding by 4 years, and their assets don't last until age 89. What if a client comes to me today and says that they want to increase their living expenses? Obviously, that has an impact as well. If I increase living expenses by 10% today, there's less income available for me because I'm drawing down from my portfolio quicker, and the growth rate on the portfolio is harder to achieve with a smaller asset base. What if a client comes to me and says, I want to decrease my spending today? How would that impact their living arrangements? As you can see here, decreasing expenses allows the portfolio to sustain its value, and the growth rate to continue to provide for income needs, and in this scenario, it provides the longevity necessary for a client to retire successfully. What if you're a client that's concerned about volatility? You want to increase or decrease your growth rate. In this case, we're going to increase growth rates. So you want to add an extra 1% rate of return. As you can see, reducing expenses or increasing growth rate has a very similar outcome. It's allowing you to preserve portfolio assets either by growing your assets or by spending less and letting your assets grow more proficiently. What if you're concerned about volatility of the market and you want to reduce your growth rate by 1%? What does that look like? Obviously, in this scenario, it wouldn't be wise to reduce your growth rate without making other changes. The assets do not provide for the goal of age 95. So when we're working with clients, we try to help them develop scenarios that meet their goal or reward, and in this case would be living to age 95. But what if they are certain that they want to give away $15,000 a year to a loved one to see them enjoy it? Should I try to make changes to a growth rate to compensate for that? As you can see in this case, the scenario works. As we give away annual to a loved one, we have to then increase our growth rate to provide for the extra needs of the portfolio. What if I want to spend more? What does that look like? Obviously, if I choose to increase my spending by 10%, I now have to rely on a higher growth rate in the portfolio. So let's change that to see what type of growth rate we need. So to increase expenses, you need quite a bit more growth rate to provide for your needs over time. So what I want to demonstrate here is that the decisions we make each day financially do have long-term impacts. And the goal of my presentation is to help us think through the level of risk we're willing to take with our assets to an attempt to achieve a stated rate of return that then provides for our rewards or our goals in the future. I'm going to switch back to my other screen and we'll close out. So give, live, save, and invest. Some of the key takeaways. Know your risk. What type of risk are you taking day in and day out? And are the risks that you have, do they accomplish the stated goals that you've discussed with your advisor? Measure your expected outcome through prudent planning. As we're all aware, if we don't know our expected outcome, we're not quite sure what risk we may be taking. As we demonstrated earlier in the presentation, risk is having an outcome different from what's expected. As we look through the planning, we can project various outcomes through different scenarios to see what might suit our needs the best. Create your legacy. What financial rewards, goals do you want to accomplish? Remember the easy to remember strategy of give, live, save, and invest. And ultimately, how you choose to do those things creates your legacy. And everyone's got a future, so let's plan one you're excited about. Thank you for your time today. I'm glad to answer any questions you may have regarding this short demonstration of risk versus reward and long-term trade-offs viewed through the eyes of financial planning. Our firm specializes in investment management, financial planning, tax preparation, and tax planning. We'd be happy to help you in any way that we can with your wealth management needs. Thank you for your time today and for your generosity in viewing this slide. Thank you.